We're now in the grips of an inflation scare that has put a chokehold on the growth stocks, and it's been a nightmare for tech. This morning, it felt like we'd have still yet another ugly session for tech. Then we got this reprieve when interest rates took a breather for an ugly close, with the Dow ultimately finishing down 470 points. S&P declining 0.48%. NASDAQ did manage to rebound 0.56%, and that is important. See, not everything can rally. When rates tumble, like today, the big industrials lose their momentum, hence the decline in the Dow. But at least the cloud, the semis, the cybersecurity stocks could climb out of the hole that they're in and lead the NASDAQ into a rare patch of green. In other words, we rolled back the reflation trade for another day. However, after a crazy year full of unprecedented action, we're finally dealing with something normal here. I've gone over the last half dozen of these inflation scares, and I think the closest analog is the one we got from December 2015 through February 2016. Back then, the economy was heating up. Our economy is heating up. Our previous Fed chief, now Treasury Secretary Janet Yellen, let us know that it was time. The economy was too strong. It had to raise rates. Had to raise the federal funds rate. Then as now, the most highly valued stocks, the ones that trade on their sales, not on their earnings, got absolutely annihilated for weeks on end. Emphasis on weeks. And remember, we're only like week 2. Of course, there's a big difference. Our current Fed chief, Jay Powell, has decided to upend more than 40 years of monetary policy. Ever since the late 70s, the Fed has been ruthless about crushing inflation, even if they have to cause the occasional recession in the process. But Jay Powell believes we're underestimating the risks of high unemployment and overestimating the risks of inflation. That was true even before the pandemic, and it's doubly true now. To a lot of people on Wall Street, though, that's just heresy. They don't trust the man. See, you got bond sellers all over the place betting that Powell will have to change his mind because the economy is going to get strong. As they see it, we're about to get a huge stimulus package that will hit right as America reopens for business because of the vaccines. So they think the economy must overheat. Therefore, we must have inflation, serious inflation. And inflation is a nightmare for people who own bonds. I mean, who wants a piece of paper that pays 1.5% when inflation could break 2%? You're losing every day. And that's why these people have been dumping bonds, and their wholesale selling always smashes the stock market. Remember, stocks are valued based on their future earning streams, and inflation erodes the value of these future earnings, which leads me to my game plan for next week. Now, normally, I'm Mr. Chronology, right? I like to do it chronologically, but we're going to go right to the chase. On Friday, we get this. It's the Labor Department's non-farm payroll report. And if this shows a big uptick in employment, then rates are going to shoot higher again. They're going to challenge, we call these the bond vigilantes, they're going to challenge Jay Powell, and they're going to say, you know what? We don't believe you. You're going to have to raise rates, and we're selling bonds, and therefore stocks will go lower. It's a new month, and that's positive for money coming in. It's a light earnings calendar, but what matters is that 8:30 Friday number. So I'm going to be asking you to be very careful trying to play the earnings next week. You can get all of these numbers right and get this wrong, and, well, let's just say you may not get the returns you'd like. With that giant caveat in mind, on Monday we get results from one of my absolute favorite companies, and it's Zoom. A year ago, this was the hottest stock in the universe. Lately, it's been stalled, but it's still up 10% for 2021. I bet Zoom can deliver still one more blowout quarter. They have a lot of different things in the pipeline, too. But the question is, will it matter? Will anyone care? I mean, Zoom's a lockdown story, right? And lockdowns come to an end. I think they surprise to the upside and give you a roadmap to the future that shows there's a lot more to Zoom than lockdown. Will anyone care? I'm not quite sure. We know the Wall Street bets crowd, they're on the hunt for the heavily shorted stocks where they can engineer a squeeze, right? Isn't that like the kind of MO? Well, that means they might be game to crush the short sellers in a company called Lemonade, as 11% of this artificial intelligence-powered insurance broker shares are sold short. Now, that's not enough for real squeeze, but it's certainly enough for the Wall Street bets people to be able to diversify away from GameStop, AMC, GameStop. Tuesday morning, we hear from Target. And this market hasn't exactly been kind to the big box retailers lately. People would much rather bet on non-essential chains that were forced to shut down last year because they'll now be able to put up fantastic year-over-year comparisons. But if any of the big box plays can pull away from the pack, it's going to be Brian Cornell and Target, simply because the stores just keep getting better and better. But after the close, we get exactly the kind of retailer that was hobbled last year and has now reopened, Nordstrom. I think the stock's gotten too cheap to ignore, and it's universally hated, even as a lot of us shop there? Wednesday kicks off with a stock that caught a double downgrade the other day. Ooh, buy to sell. I'm talking about Dollar Tree. I happen to like going to Dollar Tree. Like Target, this is another essential retailer that will be up against some very tough comparisons for the next few months. That said, Dollar Tree, remember, you got a huge share of stimulus checks coming. They had a nice percentage of them last year. So I don't want to bash it too much. Maybe it's going to come down enough. Let's be careful, though. The dollar stores are all for sale. Wendy's reports too, and that stock's been drifting lower, despite what I expect will be good same-store sales, not just because my wife loves that double Baconator. I happen to think it has some calories. She's been fooled. Now, I want you to be careful. Wendy's has been known to trade down initially on good numbers before rebounding, so I'd say wait until you see the whites of the seller's eyes. All right, here's one that this is the talk of them all. Yeah, American Eagle Outfitters. I bet it's got some excellent lift from its Aerie division. That's spelled A-E-R-I-E, just to date myself. I'd actually take a swing at this one. This is the one. I mean, look, if L Brands can get up to 70, come on, this one can do it. Oh, here's one that might be the ultimate litmus test of the bond market's tyranny over stocks. One of my favorites, Snowflake. This smart data warehousing play is the fastest growing company right now that I follow. But it won't mean a thing if it ain't got that bond swing. Pretty good, huh? You have to take your cue from bonds before you can decide if it's worth buying. If bond yields start soaring again next week, Snowflake could shoot the lights out, and it might not matter. And that's run by Frank Slootman, and I think it's an amazing company. Thursday morning, Kroger reports some real skepticism about whether it can deliver a good quarter. And earned downgrade the other day posited the competition and labor costs might be too much for them. So I think you should sell Kroger. After the close, we hear from Costco. This one's tough because everybody's selling this one. Now, we own it for a charitable trust. We've owned it for a very long time. It's been clobbered. I feel awful when I look at it because it's a great company, but the stock has not had an ounce of momentum upward since they paid that $10 special dividend. Plus, it has a habit of swooning right after reports. So here's what you want to do. If you want to own Costco, you wait till after they report. When they talk about their guidance, Rich Galante's amazing. The CFO, he's my fave. For the record, if you don't own Costco and it gets hit, would you just buy a little for me? When we get to Friday, if the employment number's wrong, because then you're going to be able to own Costco for the next decade. Finally, yes, we do have the employment number. If we get any strength here at all, please brace yourself for another tsunami of selling as interest rates go higher and stocks go lower. Without an ugly set of numbers, the growth stocks are in trouble. Okay, here's the bottom line. I don't know if the growth names can withstand the pain, but today's session did give us a glimmer of hope that they can still rack up some gains, even if in the midst of an inflation scare. But if you don't like the pain and you believe in my 2015-2016 analogy, hey, it's fine. You might want to use some moments like this in the NASDAQ, take some profits, and get ready for a swoon into Friday, and be ready to buy stocks like Costco. Okay, I want to go to Amin in Washington. Amin.
Booyah, Jimmy Chill.
Booyah, my friend. What's happening?
Hey, Jim. I was just calling in regards to BYND. I had a couple of questions for you.
Sure.
Not too long ago, they had a partnership with PepsiCo. The stock surged approximately 30% upon the news, and I bought some shares. The past few days, the stock price has been mellowing out, and I just wanted to ask, should I hold my position?
I want you to buy some. Here's why. Let me give you the brief on this. They happen to have a substantial food service division, and when the economy reopens, that business is going to be great. In the meantime, they're doing well in the supermarket, and let me just be really clear. They don't have GMOs. And this younger generation, they're not like us. They're not fooled. If they see GMO, they don't like it, and Beyond Meat has no GMO. And I like it, and I like Ethan Brown. I want to go to Brian in New Jersey. Brian!
What's up, Jim?
Not much, a little rehab. How about you?
First time caller, first time booyah, Jim.
I like that. Initial booyah.
Need your help, Jim.
I'm here.
Stuff up. My broker's spitting out kidney stones as we speak. I'm stuffing my face with those sloppy Joe sandwiches down in Millburn. You know what I'm talking about.
Oh, my God.
Need your help.
Oh, my God. You know, that line is so bad. You know, it's like when I was with Haley last time I was in the line, I didn't get the sandwich right, and everyone was looking at me like, what is he doing? So I get that. What's the stock?
Alibaba, ticker BA.
Look, Alibaba's come back down. It was at 260. You know, when David Faber found Jack Ma, right? Who did he find? We found Jack Ma? What? It was like 212. Then it went up to 267. It's coming down now. It's in your sweet spot. It's as good as the Sloppy Joe that, if you don't mind, I'd like one, and I want extra pickles. Okay? Can we have David in New York, please, David?
Hey, Baba Spackalicious booyah to you. I've been watching your show since you first started. Love what you do for the small-time investor.
Thank you. They had rabbit ears back then. I'm not kidding. When I started the show, we had rabbit ears. Go ahead.
Yeah, I remember it. It was great. My question is in regards to EV Box Group, the EV charging specialist that agreed to go public.
Yes.
To merging with the SPAC TPGY. I like playing it because it's another way of playing the EV craze, which hasn't gotten loud yet. But since you last recommended it as one of your favorite SPACs, there was news that Coach Investment is announcing a partnership with them because they think they're going to be a global leader in EV charging stations.
I think it's good, but remember, this group is for sale. Everything's for sale. We were trying to put these in the context that everyone wants EV, and this one's come down, and we said as they come down, if you believe in EV, pick one. We picked that one. We really like it. There's a couple others that we're looking at. But remember, the market's gotten unkind to all the SPACs, except for, by the way, hey, did you see Fisker after we had Henrik Fisker on? Winner, winner, chicken dinner. All right. After a crazy year full of unprecedented action, we're finally dealing with something normal around here. It's an inflation scare, and you're getting what always happens when stocks go lower as interest rates go higher. Mad tonight. Is it nothing but net when it comes to Arista Networks? I'm going to sit down with the CEO after 6 years of not being able to see her. And boy, I think they're going to have a great 2021. Then what's working with Workday? Stocks dropping with the rest of the market, but maybe it's a buying opportunity. Don't give up on everything, please. And my exclusive with an under-the-radar winner in the fight against COVID-19 that I really like. I'll reveal the name when I sit down, although I've never sat down since I started the show, with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.